If I handed you $100,000 today and told you you could only invest in one of these two ETFs, which would you choose? Would it be SCHD or would it be JEPI? These are two of the most popular income-focused ETFs on the market today. But here's the thing. Most investors compare them incorrectly because while they may seem similar on the surface, they're actually designed to accomplish very different goals. And today I'm going to be showing you exactly where I would put $100,000 and why. Now, before we dive in, let's get one thing straight. This isn't about which ETF is better. The real question is, better for what? Because one ETF is primarily designed to help you build wealth over time. The other is primarily designed to generate income today. Understanding that distinction changes everything. So let's begin with SCHD, or the Schwab US Dividend Equity ETF. And for those of you that have followed me for any amount of time, you know SCHD has been a big part of my portfolio for quite some time. And if you're interested in seeing my entire portfolio, get trade alerts, my weekly market report, sentiment report, access to our valuation website, and option trades, then make sure you join my investing community, the Stock Investor's Edge. And if you're watching this video on release day, this is the final day of our summer sale that will get you 15% off any of our subscriptions. So make sure you check out the pinned comment down below and join the community today. All right, let's get back to SCHD, which focuses again on high-quality dividend-paying companies. But what makes SCHD different is that it doesn't simply chase the highest yield. Instead, it emphasizes strong free cash flow, profitability, dividend growth, and balance sheet strength. When you look inside SCHD, you're generally finding mature businesses that continue growing earnings and dividends over time. The goal isn't just income. The goal is growing income. And that's an important distinction because a dividend that grows every year can become incredibly powerful over long periods of time. Here's a look at those dividend stats that currently show the ETF has a dividend yield of 3.3%, a 5-year dividend growth rate near 10%, and coming up on 15 consecutive years of dividend growth. The ETF checks off all the boxes: higher yield, strong dividend growth. In fact, SCHD has a higher yield than most high yield focused equity ETFs and faster dividend growth than most dividend growth focused ETFs. Now, what I want to do is show you the sector breakdown by first looking at the sector exposure as of the end of Q1. And at the top, we saw consumer staples made up 19%, healthcare nearly 19% exposure, energy 17%, industrials 11%, and then technology. SCHD has not been an ETF that often has much exposure to the tech sector, and the tech exposure it has is more of the mature names, not the Microns or Marvells of the world. But because of how strong the tech sector has been performing the past few months, check out the latest shakeup in sector exposure. Technology is actually now the leader, accounting for 19%, healthcare at 18%, consumer staples 17%, energy at 15%, and financials rounding out the top 5 at 9%. SCHD does rebalance on a quarterly basis, so I fully expect the tech sector weighting to drop back down a little bit, but this is certainly some of the highest tech exposure we have seen, and I gotta say, I actually like it. And with that, here are the current top holdings, which include Qualcomm and Texas Instruments at the top, followed then by United Health, Merck, Chevron, Verizon, Procter & Gamble, ConocoPhillips, and Amgen. The top 10 stocks make up roughly 40% of the ETF. So again, the focus is on a multitude of different things: dividend payers, dividend growth, quality companies, solid balance sheets, and intriguing valuations. And again, the best well-rounded dividend ETF in my eyes. And before we look at JEPI, let me take a moment to thank today's video sponsor, which is the Motley Fool. The Motley Fool has a ton of great resources and products available for investors of all different levels. And right now, if you go to fool.com/Mark, you can check out their top 10 stocks to buy right now. All right, with that being said, now let's take a closer look at the makeup of JEPI, or the JP Morgan Equity Premium Income ETF. JEPI is the ETF that put premium income ETFs on the map. Since coming about in 2020, JEPI has exploded in popularity over the past several years, and it's easy to see why. Investors love income. JEPI combines a portfolio of stocks with an option strategy designed to generate additional cash flow and increase the yield. So the idea is to receive dividend income from the stocks they own in the ETF, and then on top of that, the managers will sell out-of-the-money call options on the S&P 500 index, which generate more premium. The result with both? A significantly higher income stream than most traditional dividend ETFs, and that income is distributed on a monthly basis. For investors seeking monthly cash flow, that's extremely attractive. but there's a trade-off. The same strategy that helps generate income can also limit some of the upside during strong bull markets. When you sell upside calls, the strike price you choose puts a ceiling or a cap on the gains for that particular period, and any gains above that level are missed opportunities. That's important to understand. With that being said, here's a look at the top 10 holdings for JEPI, which include Ross Stores, Apple, Helmet Aerospace, AbbVie, Nvidia, Alphabet, EOG Resources, J&J, Amazon, and Eaton. But as you also can see, the position sizing is small, with the top holdings having less than 2% weightings. The ETF currently has a juicy yield of 8.3%, but also, as you can see, no dividend growth over the past 5 years, but distributions are monthly. So if you like yield, it's very intriguing, but at the same time, looking at this chart from a performance standpoint, your investment is not appreciating all that much over the course of the past 12 months. And in fact, over the past 5 years, when the S&P 500 has seen huge gains, JEPI is down over 5% during that period. So that is the downside. So now that we understand the makeup of both, let me quickly walk you through my compounding calculator. And we're going to look at two scenarios, one for each ETF, as if we were to invest all 100,000 into each of these using their current performance and dividend stats. So let's begin with SCHD, in which we see at the top 100,000 initial investment. And let's just say we add $2,000 per month to our investment. The annual performance growth has been around 10%, and the dividend yield is currently at 3.3%, with a 5-year dividend growth rate right at 9%. So assuming those stats moving forward, you can get the idea on where SCHD could go if these remained. By year 5, our dividend income would be nearly $9,000 per year. Up to year 10, over $20,000. And by year 20, you are earning around $75,000 in annual dividend income. But look at the year 20 market value. This is really where that compounding takes place. That initial investment is now up to around $2.7 million. Again, these are all consistent estimates, but it gives you an idea as to the power of compounding. Now let's move over to JEPI. Same starting investment, same monthly addition. Average annual share growth is around 1%, which is actually being generous. The yield's at 8.3% and no dividend growth. By year 5, dividend income's at $20,000. We start at a much higher base because of the higher yield. By year 10, you're up to $40,000, and by year 20, over $100,000 in annual dividend income. But here's the catch. The total value of your investment is at $1.5 million, which is still solid, but falls well short of the $2.7 million SCHD gave you. So just another way to look at both of these ETFs. But here's where I think many investors go wrong. They ask, which ETF is better? That's the wrong question. The better question is, what am I trying to accomplish as an investor? Because SCHD and JEPI are trying to solve very different problems. SCHD is focused on long-term wealth creation, dividend growth, and capital appreciation, whereas JEPI is focused on generating income, reducing volatility, and producing cash flow today. Those are very different objectives. Let's say you are in your mid-30s, still working likely, and you have a long-term horizon. You likely should not be focused all that much on income today. In that situation, I'm choosing SCHD, and it's actually not that close. Why? Because I want dividend growth, I want earnings growth, and I want long-term compounding. I want my income stream to be larger 10 years from now and not so much today. SCHD is built for that. Now let's change the situation and say you're retired in your mid-60s. My portfolio needs to help pay bills. I care more about income today than maximum growth. Well, in that case, now JEPI becomes much more interesting. I didn't say all, but much more interesting because it provides a significantly larger cash flow stream. And for many retirees, that income can be incredibly valuable. In that scenario, I might lean towards JEPI for some exposure. But let's just answer the question. If I had $100,000 today, where would I put it? And for my personal goals, I would choose SCHD. Not because I think JEPI is bad, I actually think JEPI serves a very important purpose. But primarily goal is still wealth creation, compounding. I want to grow my dividends. I want quality businesses, and I want long-term appreciation. And I believe SCHD is better positioned to deliver that over time. Many investors could benefit owning both in your portfolio to some degree. And I have owned both in my portfolios at times. When do I invest in JEPI, you might ask? Well, when I have raised cash and it's uninvested. I would rather put money in JEPI and have it generate higher near-term income than just sitting in a money market account, especially since I can access the cash rather quickly if needed. So if I had $100,000 today in my current situation, I can only choose these two ETFs. How would I allocate it? It would probably go 90% into SCHD with the final 10% going towards JEPI. But again, if I were retired and later in life, I could see a situation where it might be closer to a 60-40 split. Still 60% going to SCHD and 40% into JEPI. The right answer depends on your age, income needs, risk tolerance, and investing objectives. At the end of the day, neither ETF is objectively better because they are so different. They are designed to do different jobs. SCHD is designed to help build wealth through quality companies and dividend growth. And if we were comparing it to other dividend equity ETFs like VIG, DGRO, VYM, then we could talk more about which ETF is better. But JEPI is designed to generate income and cash flow today. The investor who understands that distinction is far more likely to make the right choice. And if I had $100,000 to invest right now, I'd personally lean much more heavily toward SCHD. Now, in the comments section below, let me know which of these two ETFs you prefer and why. And if you enjoyed this video, do me a huge favor. Click that like button down below. Subscribe to the channel. Thanks again for watching, and make sure you take advantage of that summer sale. Thanks again. We'll see you in the next one. Take care.